Hey, it's Dave Brown here, host of Now with Dave Brown on AMI. Check out this latest highlight from the show.
It's the height of the RRSP season, but your financial planning goes well beyond what you have in an investment portfolio. Have you considered life insurance plans? Certified financial planner Ryan Chin has some perspective to share. Ryan is a CFP at Sun Life Financial. Hey, good morning, Ryan. Nice to chat with you this morning.
And to you, Dave. Good morning.
Ryan, you and I have been having this conversation together for about a year now, give or take, and there have been a lot of points where you and I share the same interest and share a similar knowledge base, but this is one where you're catching me totally out of left field. I know almost nothing about life insurance, so I've got to start here. Why are life insurance plans an important piece of financial planning?
Yeah, so Dave, really it's about risk management. Part of that also is life insurance is a tool as part of the overall financial plan. You know, we have an RSP, we have a tax-free savings account, and we have a life insurance policy. These are not just things that we put in place because, oh, someone told us we need, but it's actually a viable part of your overall plan. For example, quickly, if someone were to be saving toward, you purchased a home and you and your spouse and everything is working out well, and one of them were to pass away, well, that life insurance really comes into play because it helps concrete the fact that now the surviving spouse is able to manage the lifestyle that you were both dreaming of.
That lends itself into a question in regards to who needs to consider this. And I'm going to put the word urgent in here, right? Because Ryan, in my case, I've got some assets, I've got some financial planning, but I also have no dependents, right? I don't have a spouse, I don't have dependents. So in my brain, the urgency isn't there. But who are the folks who should be urgently considering life insurance?
So to your point, Dave, to your particular situation, I would challenge you to say, have you maxed out your TFSA? Quick question.
Nope.
And if you have, because some folks who are in the similar situation who have maxed out their TFSA, life insurance is an additional TFSA style product. Anyways, besides the point, to get to your actual question, is there urgency? Dave, life insurance is based on need. It's not based on want. So there's typically not urgency. However, when we look at planning and we think about our future and we think about what are the things that we want to protect in life, that then underscores the value of life insurance. For example, if you said to me, Ryan, I want to make sure I leave, a legacy gift to my favorite charity. Well, that is a permanent need. That's a need that, it's close to your heart, and you want to protect that by, solidifying whatever that particular volume of cover, volume of gift that you want to leave to that charity. So again, it's about need. It's about making sure that the plan fits for your particular situation and that you're not paying more than you need to just because someone thinks that, you should.
Ryan, I remember when I used to work in your world, something that we used to offer on mortgages was a kind of life insurance. I know that can exist in other kinds of loans as well. So what are the different kinds of plans that exist? I know this is a big loaded question. Yeah. Please feel free to take your time with it, because I think this is one where we could find ourselves in the weeds pretty quickly.
I do think so too, Dave. And really there's a difference between mortgage protection, or what they would call loan protection insurance, versus life insurance. So again, two very separate products. Essentially, life insurance boils down to, three main style products. There's term insurance, there's permanent or whole life insurance, and there is participating permanent. And in some cases, some folks call that universal life insurance. Three very separate products, and each of them have a specific need. For example, term insurance. It is exactly as the name implies. It is a term product. That means it has a beginning, a middle, and an end. Term insurance is something you purchase for a term need. again, that mortgage. If you have a mortgage, well, we hope you're going to pay off that mortgage quickly. So the term should suffice for that particular need. Whereas whole life insurance or permanent insurance would be a product purchased for a permanent need. You have a small child you want to leave some money to, you have a legacy gift, maybe you want to leave a big bequest to your favorite charity or university or whatever. Whole life insurance is a permanent need. That's something near and dear to you. Then, when we look at participating permanent or universal life products, those products also fit that permanent need, but the added value of those type of products is that estate protection. If you have a principal residence and then maybe you purchased an income property and you want to make sure that that income property is passed on to your legacy, to your children, and you don't want them to have to go out of pocket to offset the capital gains. Now we're getting in the weeds, Dave. I'm sorry. But participating permanent insurance covers that need. So, I mean, again, we would really, the first step when thinking about any style product, what we need to do is determine what is the need and what is the purpose of the product.
Mm. You mentioned there's these different forms of plans. What are the rules about having multiple plans?
Well, Dave, I would say any life insurance company would be happy to sell you multiple plans. And that is the fact. There really isn't a limit on how many you can own. Because at the end of the day, it does boil down to need. And if your need is such that you need to own a number of different plans to cover off different needs, then by all means, it can work. For example, there may be a situation where you can own one of each type of plan, a term insurance, a permanent insurance, and a participating permanent insurance, all under one profile because that fits the need of your current situation.
Mm. Ryan, no need to go too deep on this front, but the application process, what's that like for an individual?
Yeah, so this is kind of an interesting one, I think, and one thing I want to sort of underscore right away is just because you would like to have life insurance doesn't mean you're always approved for life insurance. For example, when we apply for life insurance, what we are doing is we're applying to transfer risk. So we want to take our risk and move it to someone else. And, whether that risk is $100,000, $1 million, $10 million, well, the person who's taking on that risk needs to ensure that they're betting on a safe gamble here. They don't want to pay out the risk. They will do so because of the nature of the contract. But if they don't have to, they prefer just to take your money.
Mm.
Now, through that application process, when you apply, all applications go through something called a 90-day interim process. And through those 90 days, the insurer will have the opportunity to ask you medical questions, maybe send a nurse over to do a paramedical evaluation, what they call a vitals check. Check out the blood, the urine, and check out your heart and height and weight and all those things. And then further to that, they may also need to send a letter to your doctor to say, hey, I want to know a little bit more information about this particular situation in this person's health history. So through those 90 days, all of that evaluation happens. The underwriter of the life insurance policy will evaluate everything, and then they will measure you up against 1 million people in your particular demographic and either approve or decline the policy
Mm.
based on that, evaluation. One more thing I'll add in there, Dave, is a rating. And in some cases where, if your risk is greater than the average person in your particular demographic, the risk is greater. For example, if you're a smoker versus a non-smoker, well, you have a higher risk. So they would apply a risk rating to your policy, so it could affect your premium.
Okay, Ryan, you have set the table beautifully here. You've laid out the facts. You've laid the foundation. Let's have the rubber hit the road for 4 or 5 minutes here, because there are some social media influencers who talk about using life insurance as, quote, infinite banking, basically a way to use a plan to build wealth while you're still alive. Ryan, I know there's some machinations that you probably have to explain here as you share your take on the practice.
Yeah, Dave, it is an incredible way to build wealth. And I will start my conversation simply by saying this is truly how the rich get richer. Now, it is absolutely a golden opportunity to use participating or universal life policies for this particular circumstance. But the misnomer in those social media ads is they say, well, you can buy one of these plans. You can then in no time take out the money and still grow wealth. Well, the fine print on this is it truly starts with the volume of coverage and the volume of premium. For example, for one of these true infinite banking plans to truly work, it takes about 10 years to build the appropriate equity in the cash value of the plan. And to that end, the volume of your premium would have to be north of $15,000 a year.
Oh my gosh.
To really start to build any kind of equity on a 10-year plan. And realistically, 15,000 is not a lot. When you start to get into plans that are $25,000 and $50,000 plans, annual premium plans, now we're talking about true infinite banking. So don't get dazzled by the headline. You got to get into the weeds on this kind of stuff. It's like buying a house, and you're if you're willing to commit to that really, and I'll say stringent payment plan, by all means, in the future, it will pay off. There is no question. They work. You just got to do it right.
Yeah, it might just take 10 years of building $250,000 worth of equity before you can borrow against the equity.
Exactly. This is not something that, hey, I'm going to put $50 a month in, and then in 5 years, I'll be able to pull out enough money to buy a house. No. And that's what many people think, is they can just start one of these things and in 2-3 years start pulling out money to buy a house. And I deal with that call at least once a week.
Hey, I've got a $1 million life insurance plan and I've had it for 3 weeks. Can I borrow $1 million? No, sir, you cannot.
You can't borrow on the face value if there is no collateral. Yes, absolutely.
Oh, the ultimate lesson in economics right there. Ryan Bradley Chin dropping some truth on you. Hey, Ryan, thank you for this. I love these segments. Love chatting with you. Have a great day at work.
And to you. Thanks. Take care and have a great day.
That's Ryan Bradley Chin, certified financial planner with Sun Life Financial. You see, I like that. Ryan countering some social media trends. It's 2 days in a row been able to use expertise against chatter that exists in social media.
Do you want to dive into more conversations like this? Watch Now with Dave Brown weekdays at 9 a.m. Eastern on AMI-TV or download the podcasts wherever you listen. Do you want to dive into more conversations like this? Watch Now with Dave Brown weekdays at 9 a.m. Eastern on AMI-TV or download the podcasts wherever you listen.